Hey Mike, walk me through from step A to step Z of mortgage financing process. Let's assume that one has been pre-approved. They have found the beautiful home that they are interested in. So what happens from the lending aspect going forward?
Good question. So, again, first step being pre-approval. Let's say we've got a client that's already pre-approved and they found a house. They're ready to make an offer.
Good.
They're going to get with me and say, hey, Mike, got this house, want to make an offer on it. I'm going to provide them a pre-approval letter that will go with their offer so that the contract and the pre-approval letter match, same address, same price that's being offered. Back and forth with the negotiation. Let's say the contract is accepted. And they're ready to, at that point, begin what we would call the official process of the loan.
That is now official process, meaning that without the contract, there is no official process from the lending aspect.
That's true, yes. Now we can, with the lending process in the pre-approval stage, we can take it as far as the client wants us to take it as it relates to their credit approval. And get their, get their documents on their employment, their assets, go ahead and have it even underwritten with an estimated price and loan amount. But again, even then it's not official because there's no property. Once there's a property, that's when we can actually lock in an interest rate. We can order an appraisal to make sure that the value that they're offering for the home is set. That's when you'll help them with home inspections and those type things. During that phase is when we will update if we haven't.
Locking the interest rate, what does that mean?
Okay, good question. So interest rates are subject to change daily.
They are subject to change daily.
Yeah, hourly even.
Hourly.
If the market is doing crazy things in a day. And as we've seen recently, that change has been up. And so you cannot typically lock into an interest rate at the market rate until you're under contract, so that we have the exact price, and we know what your loan amount is going to be, and we have an exact closing date. Because most interest rate locks are based on a specific time period. 15, 30, 45, 60, long-term 90, 120 type days. Until we have that contract, we don't really know what that time period needs to be. And so once that happens and you lock the rate, all that means is we can actually guarantee that the client, regardless of what rates do from this point forward, this rate that we're locking in for you today is the rate you're going to get when you close.
I've had some people ask me, well, if you lock my rate, let's say, just throwing numbers out there, say at 7% today, and I'm closing my house in the next 45 days. Between now and 45 days, interest rates drop. Do I have the options for the lender to drop my rate as well?
Most of the time, the answer is yes. Most lenders will have an ability, depending on the investors that they're working with, to do what's called a rate renegotiation. So if the rates do come down, a significant amount, then you can renegotiate that rate. Now, you may not get exactly where the market has dropped to, but let's say you locked in a rate at 7.5% and the rates have dropped to 7. Then you can typically renegotiate a rate to like 7.25. So somewhere in between.
Somewhere in between. All right. Well, that would be good news.
So it's better, better than nothing. And the good news is that if they've locked in at 7.5 and rates go to 8, they get 7.5.
Awesome.
It just kind of gives everybody,
peace of mind.
Peace of mind throughout the rest of the process.
That's one thing that I tell people, that I put so much priority on people having peace of mind when they are buying their house or selling, because there is so much emotions that goes into the process of buying, and having that peace of mind is critical.
Absolutely. One of our goals, because we do realize there's about 5 major life events that create the most stress: a death, a marriage, a birth, a change of location, a change of job. Most of the time when someone's buying a home, there's at least 2 of those going on at the same time. So we realize that, and we do our best to make the process as efficient as possible to give the people the peace of mind from day one. This is going to work out.
Awesome. So let's continue in what happens in the process.
Okay, so what will happen in the process once we're under contract, ready to move forward? As I mentioned, some of the things like appraisal, home inspections, those type of things are done at that point. We will update any documents such as pay stubs, bank statements that need to be updated from the time that maybe we did the pre-approval to make sure all the information is still accurate and that the approval is still good. Once we've done that, have the appraisal back, the loan will be underwritten. So once the loan is underwritten.
What does it mean for the loan to be underwritten?
Good question. So typically, most lenders will use a automated underwriting engine through either Fannie Mae, Freddie Mac, FHA, VA, and get an automated approval. But I would also say that 99 out of 100 lenders also will have a human being who would be called an underwriter, review those automated underwriting findings,
I'd say.
compare it to make sure that the documents match up to those findings, and then give the final stamp of approval from an underwriting perspective.
Okay.
So that's really kind of what you're talking about with underwriting.
Underwriting.
Yeah.
So is that a point that I'll see the underwriters requesting for additional documents
Maybe.
from the buyer?
Yep.
Okay.
Maybe as an example, let's just say there's an employment situation where they're on commission and maybe the commission is quite a bit higher now than what it's been. Maybe that they want an explanation from the client. Hey, why did your commissions go up so much? The deposit went into their bank account that didn't really match up with their income that would typically go in every month.
Okay.
May need to know why that happened. So those are a lot of things. We try to catch those even before it goes to underwriting.
All
But
right.
those are some items that, an underwriter could catch, come back and say, hey, I've approved this loan, no problem, but I want an explanation or I want additional documentation on one or two specific things.
Well, but that is a stage where I've seen so many buyers get frustrated because they said, well, I have given you all of this information upfront during my pre-approval process. Why on earth are you asking for the same information again?
Again, back to my comment about an efficient process, one of the things that we've done, again, the experience, my team's been together for a long time, we try to preempt those things. We try to make sure we're getting what we need even before. So that anything underwriting might ask for is something simple that client, no problem, happy to do that. So we try to avoid those situations. Sometimes, when you're looking at, you may have a difference of opinion as to how the document should be interpreted.
Interesting.
And sometimes in those situations, most of the time I'm going to have a conversation with an underwriter. We'll come to an agreement. But sometimes it does require the client to get back involved, provide some additional support to help explain what it is that there's a little bit of maybe a difference of opinion.
Okay, interesting. Well, we are human beings. We always have difference of opinions.
That's going to be a thing that because there are humans involved, there's always the opportunity for a mistake. There's always the opportunity for a difference of opinion. So that's again.
So it is not an exact science.
It's not. It's kind of like an appraisal. People want to know why is the appraisal this, and then this same appraiser appraises it for this.
Yeah.
Because it's not an exact science. They're using the same information, but it's got human involvement.
Let's say we have been able to scale through the underwriting process. What happens next?
So once the loan's approved, we'll let everybody know that closing, depending on when the schedule of the closing is, we're required from a compliance standpoint to make sure that the client has all the closing documents that they need at least 3 days prior to their closing. Okay. So we'll make sure that happens. Once that's done, it's just a matter of scheduling the closing. Client will go typically to an attorney's office that handles the actual closing itself. We'll provide the documents that they need to be signed.
Okay.
Signed and
ready to roll.
Take on a new debt, get to the house, and ready to go. Yeah.
Now let's talk about this piece. That I think we skip in the underwriting process. That because I know that the lenders are also in the business to make money.
Correct.
Right.
Mm-hmm.
So how do they come to the point where that the house that the buyer is buying is worth the value that they want to borrow?
Okay, so that's where the appraisal comes in.
Okay.
When we hire an appraiser, we hire someone who has been certified to be able to determine values.
Okay.
That's their job. And so an appraiser will go out, do an appraisal. They will typically get 3. They have to get 3. Sometimes you see 4, 5, 6, depending on how maybe close the value is to determining an amount. But they're looking at 3 similar houses that have sold in the area.
Okay.
Hopefully within the last 3 to 6 months.
Okay.
And basically making adjustments. As an example, if this house has 3 bedrooms and 2 baths, and they're using another example of a sale that sold down the street 2 months ago, but it had 3 bedrooms and 2.5 baths, got to make a little adjustment for that extra half bath to come up with a value. So that's kind of how that's being done. The challenge there is that you've always got houses selling. You've got the overall values going up and going down. That's where the human interaction kind of comes in. That's why the numbers can look different. But to determine a value, that's predominantly what we're doing.
Okay.
Now we also have the ability in a lot of different scenarios where our automated underwriting will allow us to proceed without an appraisal.
Interesting.
In which case, Fannie Mae, Freddie Mac, the 2 predominant investors of loans, they have a huge database of deals done.
Okay.
So they know what values are based on the deals that they've done in the past.
Okay.
If they've got a deal, they're looking at that, the client's good credit, good income, no issues, putting a decent amount of money down, and looks like that the price is in line with what's sold in their area that
Okay.
matches up with their database, go forward with no appraisal if that's what the
Interesting.
client wants to do. So we don't have to have an appraisal every time, but when one's required, that's how the value is determined. It's not something
Interesting.
that is done internally with the lenders. They'll hire that out to a third-party appraiser.
Interesting.